imagine you're running a business, right? Your flagship product is literally out there successfully treating cancer. Your sales skyrockets by like 700% in a single year.
Right, which is just the dream scenario.
Exactly, the absolute dream. And then your reward for all this is an official earnings report saying you just lost $632 million in 3 months.
I mean, it sounds like a massive clerical error.
Yeah.
Or, honestly, just a really terrible punchline.
It really does. But that's exactly what we're looking at today. We are doing a deep dive into the world of commercial biotechnology, specifically focusing on ImmunityBio. Their ticker is IBRX.
Yeah, and it's a wild ride.
Oh, totally wild. We've got their Q1 2026 financials, some really recent clinical updates, and a ton of market sentiment data in front of us. And the mission for you, listening right now, is to kind of cut through all this intense financial noise. We need to figure out if ImmunityBio is a genuine turnaround story like medically and financially, or if it's just, a speculative trap.
It's such a phenomenal case study because, well, the surface level numbers are just entirely contradictory. You have this incredible commercial success running headfirst into these terrifying accounting figures. So to really figure out if this stock actually has long-term viability, you have to decode the mechanics of both the human immune system and Wall Street accounting,
Which are both incredibly complicated systems. So let's start with the product that's actually driving all of this, because before you can understand the crazy stock price, you really have to understand the science behind it.
Absolutely.
The entire growth story here, the whole thing, revolves around one single asset. It's a drug called Anktiva. And the financial translation of this drug hitting the market is just eye-watering.
It really is.
I mean, in Q1 2026, their net product revenue hit $44.2 million. That is up 168% year over year.
And, keep in mind, that follows in 2025 where their full-year revenue was $113 million, which represented a 700% increase over the previous year.
Wow.
So their unit sales volume for Anktiva is just surging. The drug is finding real, tangible traction in the oncology community.
Which obviously begs the question, what exactly is Anktiva doing inside a patient's body that makes it so incredibly valuable?
Well, it represents a genuine shift in how we approach immunotherapy. Anktiva is a novel IL-15 receptor agonist.
Okay, that's a mouthful.
Right, I know. Let me put that in context. For the last decade or so, the absolute biggest breakthroughs in cancer treatment have been checkpoint inhibitors. Drugs like pembrolizumab, which, most people probably know as Keytruda.
Oh, sure, Keytruda. And those checkpoint inhibitors work by basically removing the camouflage that cancer uses, right?
Precisely. Cancer cells have these proteins that basically signal the immune system to just back off. Checkpoint inhibitors block those proteins. They suppress the pathways that cancer uses to hide, which then allows the immune system to actually recognize the threat.
Okay, got it.
But Anktiva takes a completely different and actually complementary approach. It doesn't just remove the blockades, it actively stimulates the immune system. Yeah, specifically, it activates natural killer cells, NK cells, as well as CD4 plus and CD8 plus T cells.
What?
So it restores immune competence and reverses lymphopenia, which is a really dangerous shortage of white blood cells.
So, okay, if your immune system is a car, the cancer essentially put the brakes on. Drugs like Keytruda take your foot off the brakes so the car can roll forward again.
Exactly.
But Anktiva is like slamming on the gas pedal. It is actively waking up the body's natural killer cells and screaming at them to attack.
Yes, that's a perfect analogy. And the crazy thing about stepping on the gas like that is that we are seeing the clinical validation widen significantly. Like the National Comprehensive Cancer Network, the NCCN, they recently updated their clinical guidelines.
Okay, and what did they say?
They included Anktiva as a Category 2A recommendation for a very specific, really stubborn type of cancer. It's called BCG unresponsive, non-muscle invasive bladder cancer.
Hold on, before we get to the financial impact of that, what does BCG unresponsive actually mean for the patient? Like, what even is BCG?
Oh, it's actually a fascinating piece of medical history. BCG stands for Bacillus comet-garin. It was originally developed as a tuberculosis vaccine, of all things.
Wait, a TD vaccine for bladder cancer?
Yeah. Decades ago, doctors realized that if you instill this vaccine directly into a patient's bladder, it triggers this localized immune response that can actually clear out early-stage bladder cancer. It has literally been the standard of care for a long time.
So you just wash the bladder with this vaccine and the immune system attacks the cancer.
That is the hope, yes. But, sometimes the cancer adapts or the immune response just isn't strong enough. The treatment fails. When that happens, the patient is now, quote-unquote, BCG unresponsive.
Ah, okay.
And historically, the next step for those patients is often a complete removal of the bladder, which, I mean, is a life-altering, devastating surgery.
Oh, wow. Which is where Anketiva steps in then.
Exactly. The NCCN guidelines are now basically saying before you take that drastic surgical step, try NKTV. Being included in those guidelines is essentially the ultimate stamp of approval. It's huge for getting insurance coverage and driving widespread physician adoption.
And ImmunityBio isn't just going after the low-hanging fruit either. They are going after the established heavyweights. I saw that at the recent ASCO 2026 conference, they presented a matched adjusted indirect comparison, MAIC.
Yes, MAFTFI.
Right, showing Anketiva comparing really favorably against pembrolizumab in this specific bladder cancer indication.
We should probably clarify what that comparison actually means, though. They didn't run a traditional head-to-head clinical trial where half the patients got Anketiva and half got Keytruda.
Because those trials take like years and cost a fortune, right?
Exactly, hundreds of millions of dollars. So instead, they used complex statistical modeling. They took their trial results for Anketiva and mathematically adjusted the patient baselines to compare them against the historical trial data for pembrolizumab.
So they are mathematically leveling the playing field to see who wins.
Yes, and the data showed Anketiva holding a strong advantage in complete response rates. So that right there is the biological moat. You have a first-in-class drug, is aggressively activating the immune system, the top oncology networks are recommending it as an alternative to organ removal, and the sales are jumping 168% year over year.
The business looks incredibly healthy on the clinical side. But, okay, this brings us back to our opening paradox. You pull up the Q1 2026 earnings report, and the GAAP net loss, the official, generally accepted accounting principles loss, is a terrifying $632.8 million.
That's a huge number.
Right. If a drug is selling so well, why on earth is a company bleeding over $600 million in a single quarter?
It is entirely an accounting illusion, and it's so crucial for anyone evaluating biotech stocks to understand how this works. That $632.8 million loss was overwhelmingly driven by non-cash charges.
Okay, non-cash charges.
Specifically, it was triggered by changes in the fair value of warrant and derivative liabilities.
Let's break that down, because to a normal person looking at a business, a loss means money actually left the bank account. Are you telling me they got penalized on paper because their stock did well?
It is completely counterintuitive, but yes. Let's use an analogy to make it clear.
Yeah.
Imagine you own a house, right?
Mm-hmm.
And it's worth $100,000.
Okay.
You need some quick cash, so you sell me a piece of paper, a warrant. That gives me the right to buy your house for $100,000 anytime in the next 5 years.
Okay, so I have cash in hand today,
Yeah.
and you have an option to buy my house later.
Right. Now imagine your neighborhood suddenly becomes incredibly desirable. A year later, your house is worth $1 million. But I still hold that piece of paper saying I can buy it from you for $100,000.
I would be absolutely terrified of you cashing in that paper. I'd lose so much money.
And corporate accounting rules agree with your fear. The rules state that the company has to record the value of those warrants as a liability on their balance sheet. Because ImmunityBio's stock price went up, driven by those surging Anketiva sales we talked about, the theoretical value of those warrants just skyrocketed.
Ah, I see.
So the company is now technically on the hook for a much larger liability because investors have the right to buy highly valuable stock at a very cheap price.
So the accounting rules force the company to mark that difference as a massive, quote-unquote, loss for the quarter, even though not a single physical dollar was actually spent.
Exactly.
It is literally a phantom paper loss caused directly by their own success.
It is. So to find the true health of the business, you really have to look at the adjusted net loss, which strips out all those non-cash derivative distortions.
And what does that number look like?
When you do that, ImmunityBio's adjusted net loss for Q1 2026 only widened slightly to $86.2 million.
Wow, which is a very different narrative than losing over $600 million.
A completely different universe. And it really highlights true operating leverage as their product revenue scales up towards their fixed costs. Things like research, development, administrative expenses. The underlying business model is actually holding together beautifully.
And the sources show their actual cash pile grew, too. They didn't lose cash, they gained an enormous amount. As of March 2026, ImmunityBio had $380.9 million in cash, equivalents, and marketable securities.
Yeah.
Just 3 months earlier, in December 2025, they had $242.8 million.
They padded their balance sheet by almost $140 million during a quarter where all the headlines screamed they lost $600 million.
That's wild.
For an early-stage commercial biotech, cash is oxygen. Having a $380 million runway significantly de-risks the near-term solvency concerns that usually terrify investors in this sector. They have a real multi-year buffer to keep expanding without having to immediately dilute their shareholders again.
Okay, so the sales are real, the cash pile is growing, and the massive gap loss is a mirage. But we need to look at how Wall Street is digesting all of this, because the stock is behaving wildly. The data shows ImmunityBio averaging a 20% weekly price change over the past 3 months.
It's very choppy.
Yeah, why is there so much extreme volatility if the underlying story is this solid?
Well, that volatility comes from a tug of war between retail hype and institutional calculation. On the retail side, there is significant momentum building. Jim Cramer recently featured the company on television, actually advising his viewers to, quote, let ImmunityBio be your speculation.
Oh man, when a personality with that kind of reach labels a stock a prime speculation, you instantly get a flood of retail day traders jumping in, which creates massive daily swings.
You do. It injects a ton of chaotic energy into the trading volume.
But I mean, it is always dangerous to follow TV personalities blindly. Momentum trades can reverse in an instant, and retail investors often end up holding the bag when the hype dies down. The institutional backing is what usually provides the actual floor for a stock.
That is the crucial distinction to make here. If you look past the television segments and the retail noise, you see institutions setting a firm foundation. H.C. Wainwright recently reiterated a buy rating on ImmunityBio, maintaining a $15 price target. The broader brokerage consensus is also a moderate buy.
How does that $15 target actually influence the day-to-day trading, though?
It creates a framework for algorithmic buying. Large institutional funds use complex computer models to trade. When the stock dips below certain technical levels, those algorithms often step in to automatically accumulate shares.
Interesting.
Their internal models validate that $15 valuation based on the real projected revenue trajectory of Antitiva. It creates a psychological ceiling, sure, but more importantly, it establishes a structural floor.
And we really have to talk about the ultimate insider confidence here. Dr. Patrick Soon-Shiong. His involvement in the company is profound. He's the founder, the executive chairman, and really the driving force. The sources imply that the sudden $140 million jump in their cash pile likely came from confident, deep-pocketed capital infusions tied directly to him and his related entities.
It is essentially billionaires aligning their own capital with the corporate interests. When insiders and related parties are injecting that level of capital, it suggests they see a very clear line of sight to significant value creation. They aren't just, hoping it works out. They are actively funding the expansion themselves.
And part of that expansion is a massive global chess game. Antitiva recently achieved commercial availability in Saudi Arabia, and they secured their first approval in Asia, specifically in Macau.
The international strategy is moving very, very quickly. But the biggest upcoming piece on the board is Europe. They currently have a submission under review by the European Medicines Agency, the EMA, for all 27 EU member states.
Wow. If they get that approval, it acts as an enormous unpriced catalyst. You are opening up an entirely new continent for a drug that is already growing at 168% year over year in the U.S.
And layered on top of all this operational growth is some unconfirmed M&A chatter, too.
Really? Mergers and acquisitions?
Yeah. Large pharmaceutical companies are increasingly looking to acquire IL-15 and NK cell platforms. ImmunityBio's unique technology makes them a very attractive potential takeover target for, say, a major oncology conglomerate looking to replace their aging, soon-to-be off-patent checkpoint inhibitors.
Okay, so we have built a very compelling bull case here. A breakthrough drug, soaring revenue, insider backing, international expansion, and buyout rumors.
That's right.
But a true deep dive demands that we stress test the thesis. What are the structural cracks? Let's look at the bear case, because right out of the gate, the valuation is steep. The company is valued at roughly 28 times their forward sales.
Yep, that's high.
And they rely entirely on Antitiva for their revenue. That is an intense level of concentration risk.
It is the ultimate vulnerability in biotech. When your single asset works, you look like a genius. But if anything, literally anything, disrupts the manufacturing, distribution, or clinical perception of that asset, the entire valuation just collapses.
And while their $380 million cash pile is a great buffer, like we said, we can't ignore the historical burn rate. Their free cash flow is deeply negative, trailing at minus $299 million.
Right.
Furthermore, they have a negative equity of minus $869 million, and they have diluted their shareholders by 19% over the past year to fund this commercial ramp-up.
That history of dilution is exactly what makes long-term retail investors really nervous. Because every time a company issues new shares to raise money, your existing slice of the pie gets smaller. The recent cash infusion definitely helps, but they have to prove they can reach profitability before they need to tap the equity markets again.
But honestly, the piece of the bear case that gives me the most pause in these sources is the regulatory execution risk. They recently faced an FDA warning letter tied to, quote, false claims.
Yeah, that's a tough one.
If a company is leaning entirely on one single drug to justify a multi-billion-dollar valuation, what happens when they get a letter like that? Like, what were the claims, and why does this matter so much?
A warning letter from the FDA regarding false claims is a severe red flag regarding operational maturity. It typically means the commercial team is pushing the marketing boundaries way too aggressively. They might be promising outcomes to doctors or patients that the clinical trial data hasn't strictly proven yet.
So it's basically an overzealous sales team running ahead of the science.
Yes, and the FDA has zero tolerance for that. If the agency decides to take punitive action, they can mandate corrective advertising, issue heavy fines, or in extreme cases, they can actually pull the drug from the market entirely.
Wow, that would be devastating.
And even short of that, it could just poison the company's relationship with the FDA, which brings us to their next major catalyst, the upcoming SBLA submission.
Okay, another acronym. What is an SBLA, and what are they trying to do with it?
An SBLA is a supplemental biologics license application. Basically, they are asking the FDA to expand the approved use of ANCAVA. Specifically, they want approval for BCG-naive CIS.
Let me guess. BCG naive means patients who haven't even tried the standard vaccine treatment yet.
You've got it. And CIS stands for carcinoma in situ, which is a very early surface-level form of cancer. Currently, remember, ANCAVA is only approved for patients who have already failed the standard BCG treatment.
Right, the BCG unresponsive one.
Exactly. ImmunityBio is trying to move ANCAVA up to the front of the line. They want it to be the very first thing a doctor tries.
Which would radically expand their addressable market.
Tremendously. But if you have a strained relationship with the FDA because your sales team is out there making false claims, the FDA might drag their feet on approving that expansion. If that SBLA gets delayed or rejected, that 28 times forward sales multiple will compress violently.
Yikes. The geographic expansion into Europe and Asia probably helps mitigate some of that risk, I guess. If they secure the EU, a regulatory hiccup in the US market becomes slightly less catastrophic. But for right now, the execution risk is very, very real. The margin for error is essentially zero.
It is. The company has to walk a very tight rope over the next 4 quarters.
So bringing all of this together for you listening, we have a drug that is fundamentally changing how we activate the immune system, acting as a gas pedal for our natural killer cells. We have sales numbers that are growing by triple digits, masked by accounting rules that make the company look like it is hemorrhaging money. We have billionaire backers and global expansion, but also high historical cash burn, immense single drug concentration, and very real FDA warning signs. How do we synthesize this into a clear view of ImmunityBio's future?
Well, the overall thesis from the analysis indicates that ImmunityBio is currently sitting at a critical 12 to 18-month inflection point. The comprehensive strategic sources give the company a 7 out of 10 bullish rating.
A 7 out of 10, okay.
Yeah, and the core reason for this optimism is structural. Their hyper-growth commercial revenue is finally beginning to outpace their cash burn.
So the revenue line is finally catching up to the expense line.
It is. The market is currently far too distracted by the non-cash gap losses and the daily 20% price volatility to see the underlying operational leverage that's forming underneath it all. With the impending FDA submission for the expanded patient population, the recent NCCN guideline expansions, and the potential for a massive EU approval, their total addressable market is scaling rapidly.
So what should someone be watching for next to prove this out?
The key milestone to watch is their upcoming Q2 2026 earnings. The market will be looking closely to see if they can cross the $50 million quarterly revenue mark.
Right.
If they clear that hurdle, it really validates the path to true operational profitability and proves the 168% growth wasn't just a one-off fluke.
It is such a fascinating setup to watch unfold in real time. But as we wrap up, there is one final detail buried deep in the sources that I want to leave you with because honestly, it feels almost like science fiction.
Oh, I know what you're going to bring up.
Right. We spend this entire time talking about Angativa, but ImmunityBio is quietly developing something else in the background. An unproven, AI-driven robotic platform called Nant Leonardo.
It is an incredibly ambitious project.
Its goal is to industrialize off-the-shelf natural killer cell production. Because right now, cell therapy is entirely bespoke. You have to take cells from a patient, engineer them in a lab, and put them back in. It is slow, incredibly expensive, and really hard to scale.
Extremely hard to scale.
But what happens if ImmunityBio's AI robotic platform actually succeeds in automating and mass-producing these natural killer cells?
It would fundamentally alter the economics of oncology, period.
Could they transform from being just a one-drug wonder with Antatifea into the fundamental manufacturing backbone for the future of all cell therapy? It is a massive if, but if they pull it off, the multi-billion-dollar valuation we scrutinized today might just be the ground floor. It's definitely something for you to ponder as you explore the future of AI-driven biotech manufacturing on your own.